If you have watched my free mentorship, you know that I always start my trading process from the condition stage. At this stage, I determine the higher time frame directional bias. If after going through this stage, I can't clearly identify where the price is likely to trade to next, either on the monthly, weekly, daily, or the 4-hour chart, I do not do anything. Instead, I either switch to trading a different market or remain patient and wait for my conditions to be present in the marketplace. Only when these conditions are present, I proceed to the pattern recognition stage of my trading process. As you have already learned, I always begin my top-down analysis on the monthly chart. I start by asking myself, where have you recently traded from? After that, I determine the institutional order flow. I check if down-close candles and inefficiencies are supporting price. Additionally, I look for sharp rejections after price trades below an old low and observe whether large candles are forming with up closes. If we look at gold's monthly chart, we can see that down-close candles and inefficiencies are indeed supporting price. Additionally, we can clearly observe that large candles are forming with up closes, which further confirms that the institutional order flow is bullish on the monthly chart. We repeat the same process on the weekly chart. Here we can also clearly see that down-close candles and inefficiencies are supporting price, and that large candles are forming with up closes. This indicates that the institutional order flow is also bullish on the weekly chart. We can now carry the weekly PD arrays to the daily chart. Here we can see the weekly PD arrays on the daily chart. If we zoom in to the current trading range on the daily chart, we can see that there was a 4-day retracement, followed by consolidation with small range candles. After that, we get a retracement and manipulation down below a daily short-term low, into the mean threshold of the daily bullish order block, as well as into the daily inverse volume imbalance, which is part of the bullish order block. Notice how the bodies of the candles are respecting the volume imbalance and the mean threshold of the order block. After this, we get a large up-close candle, signaling that it's time for another leg up. To summarize, we trade below a daily short-term low, into the mean threshold of the bullish order block and the volume imbalance, which is part of the bullish order block. We immediately rally and close with a large up-close candle, which clearly indicates that the institutional order flow is bullish, and we can now carry our PD arrays to the 4-hour chart. Here is the 4-hour chart, zoomed out so we can see the daily trading range. But if we zoom into the 4-hour trading range, we can truly see the consolidation with small daily ranges. Then we drop lower to take out the sell-side liquidity pool, which is the manipulation. Notice how the bodies of the candles on the 4-hour chart are respecting the daily volume imbalance and the mean threshold of the daily bullish order block. After that, we get large range up-close candles on the 4-hour chart, creating inefficiencies. The next day is CPI day, so everything is set. We have both daily and 4-hour institutional order flow confirming that higher prices are in order, and we have a high-impact news event scheduled for the next day. This means we can expect a trade to form during the New York session. Observe the small bodies of the candles, indicating volatility contraction, overnight and during the London session. Then, after the CPI news event, we get another manipulation, followed by a rally higher to take out the buy-side liquidity pool, above the relative equal highs. Before we move to the intraday charts, I want to draw your attention to the bodies of the 4-hour candles, and how they are respecting the new week opening gap from 9th of March. This is another telltale sign that higher prices were in order for gold. Here is the economic calendar for 12th of March. We are interested in trading only after the CPI news release. Here is the 1-hour chart. We can see a large wick candle taking out the sell-side liquidity pool, followed by a rally higher with large up-close candles to take out the buy-side liquidity pool and trade into the new week opening gap from 23rd of February. Here we can see the 15-minute chart. This chart clearly shows the consolidation before the CPI release. We rally to entice early buyers. And after the CPI, we drop into the optimal trade entry below the relative equal lows, into the 15-minute fair value gap BC, and immediately rally higher. If you have watched my free mentorship, you know that this is my #1 pattern that I look for at the pattern recognition stage of my trading process. It's also ICT's favorite pattern, and he refers to it as ICT Bullish pattern #1, the internal range liquidity, fair value play, or optimal trade entry. After I spot one of the 3 bullish patterns that I hunt for in price action, I proceed to the execution stage of my trading process. As you know, I can either enter on the higher time frame or refine my entries in the lower time frame to minimize my risk and maximize my reward. In this case, I took my trade on the 5-minute chart. We traded below the relative equal lows into the sell side liquidity pool and into the 15-minute fair value gap. After that, we get a displacement on the 5-minute chart, along with the shift in market structure and the 5-minute fair value gap that overlaps with the 5-minute inversion fair value gap. For further confluence, there is also the new week opening gap from 9th of March. If you recall, the candles on the 4-hour chart were respecting this new week opening gap. Everything comes together so beautifully. As soon as you identify the fair value gap, you immediately set limit orders into the marketplace and place your stop loss below the lower time frame short-term low, which is under the first candle that forms the fair value gap. You already know where you will take profits, so at this point the trade either works or it doesn't. In any case, I go on to the next trade. And here we can see that gold sharply rallied, way past our take profit levels. Unfortunately, I was only able to buy 2 contracts, so I couldn't hold a runner. But even without a runner, the reward was well worth the risk. For extra confidence, I also monitor the dollar index when trading gold. When I'm bullish on gold, I want to see the dollar declining, as this makes it much easier for gold to expand higher. In this case, we can see that the dollar sharply declined as gold expanded higher, taking out the relative equal highs on the daily chart. When trading gold, you also want to analyze silver to determine which one is a better buy. In this case, gold was clearly stronger than silver, making it the better buy. This is evident in the chart, where silver has deep retracements while gold rallied higher with little to no retracements. And here are my executions. I trade my personal live account with AMP futures. And here you can see the results. I bought 2 micro gold futures contracts at 2,920.8 and took my first partial profit at 2,938.7, 1 tick below the Monday high. And I took my final take profit at 2,950, which is the consequent encroachment of the new week opening gap, located just below the daily bearish order block. As you can see, this gave me a combined risk-to-reward ratio of 4.62. My risk per trade is typically around 3%, but this time it was 3.33%, which resulted in a 15.40% gain on the account.